Something strange is happening in the silver market right now, and most people have no idea how big this story really is. What looks like a normal price chart may actually be hiding one of the most dangerous financial risks since the 2008 crisis. Behind the scenes, trillions of dollars in paper silver contracts are stacked on top of each other like a fragile tower. If even a small part of that tower slips, the shock could move through banks, hedge funds, and global markets faster than anyone expects. This is not just about silver going up or down next week. This is about whether the financial system built around silver derivatives can survive real physical demand. Before we go deeper, if you follow financial warning signs and want calm, clear breakdowns like this, tap subscribe now and stay with Bullion Alert HQ. These stories often unfold slowly at first, and the early viewers are always the ones who understand the move before the crowd. Most people think silver is just another metal used in jewelry or electronics. But in reality, silver sits at the center of industrial supply chains, solar production, military tech, and currency hedging. That means the price of silver does not just affect investors. It affects factories, energy systems, and even national security planning. Now here is where the derivatives problem begins. The amount of paper silver traded daily is massively larger than the amount of real silver that actually exists for delivery. Imagine a warehouse holding 1,000 real silver bars. Now imagine traders selling contracts representing 50,000 bars based on that same supply. As long as nobody asks for delivery at the same time, the system looks perfectly stable. But if enough buyers suddenly want real metal, the math breaks instantly. This structure is called leverage, and leverage always works until it doesn't. History has shown again and again that highly leveraged markets collapse suddenly, not gradually. Back in 2008, mortgage derivatives were considered safe, boring, and well-controlled. Then, within months, the entire global banking system nearly froze. Today, many analysts quietly worry silver derivatives may be even larger relative to the physical market than mortgages were to housing supply. That is why some insiders have started calling this the hidden time bomb. Here is what makes silver especially dangerous in this situation. Unlike stocks or digital assets, silver is a physical industrial material that companies actually need to run factories. If supply shortages appear, buyers cannot simply wait forever. They must secure metal quickly, even at much higher prices. This creates what markets call a squeeze scenario. And squeezes in leveraged markets tend to move violently. Over the past few years, physical silver demand from solar panel production has surged dramatically. At the same time, new mining output has not grown fast enough to match that demand. This slow tightening of supply has mostly gone unnoticed by everyday investors. But inside commodity trading desks, it has absolutely not gone unnoticed. Some large institutions have quietly started increasing their physical holdings instead of relying purely on contracts. When big players switch from paper to real metal, it usually signals rising concern about counterparty risk. Counterparty risk simply means one side of the trade might not be able to deliver what they promised. And in derivative-heavy markets, that risk spreads like falling dominoes. One failure can trigger margin calls. Margin calls trigger forced selling, and forced selling can trigger liquidity freezes. This chain reaction is exactly what turned a housing slowdown into a global financial panic in 2008. The pattern always starts small, then suddenly accelerates. Right now, silver prices may look calm on the surface, but calm markets often hide the largest structural pressures underneath. Another issue few people talk about is the concentration of short positions in silver futures. A surprisingly small number of financial institutions control extremely large, short exposures. If prices begin rising fast, those short sellers would be forced to buy back contracts quickly. That buying pressure alone could push prices even higher. This is known as a short squeeze spiral. And historically, once a real squeeze begins, it becomes almost impossible to control. Retail investors often assume governments would step in immediately to stabilize markets. But interventions usually happen slower than people expect, especially in commodity markets tied to global supply chains. By the time officials fully react, price damage is often already done. and markets rarely return to their previous structure afterward. At Bullion Alert HQ, we track these early structural warning signals instead of daily noise, because the biggest financial shifts always start quietly before they become front-page headlines. So the real question is not whether silver can move. The real question is what happens if the derivative structure supporting the market suddenly loses trust. And that is exactly what we are about to break down next, because the size of this derivatives exposure is far larger than most public estimates suggest. Once you understand how large it truly is, the risk picture changes completely. To understand how serious this situation could become, we need to look at how modern commodity derivatives actually function in the real world. Most viewers assume contracts simply represent real metal stored somewhere safely. In reality, many contracts are rolled forward repeatedly without ever touching physical inventory. This creates a synthetic supply that exists only inside trading systems. For years this worked because physical delivery requests stayed relatively low. But the environment today is very different from the low-demand world of the early 2000s. Green energy expansion alone has created massive new industrial silver demand. Electric vehicles, solar infrastructure, and high-efficiency batteries all require significant silver input. This means the buffer between available metal and promised metal is shrinking, and shrinking buffers are exactly what make leverage systems fragile. If a sudden financial panic hits global markets, investors often rush into hard assets. Gold usually leads that movement, but silver historically follows with more explosive percentage gains. That is because silver's market is much smaller and thinner than gold's. Smaller markets react faster when capital flows suddenly increase. Now imagine that kind of investor rush happening while industrial buyers are already competing for supply. That combination could overwhelm the derivative system extremely fast. Banks exposed to large silver derivatives could suddenly face massive collateral demands. And when banks start scrambling for liquidity, broader credit markets feel the pressure almost immediately. Credit tightening does not stay inside commodity trading desks. It spreads into business loans, mortgages, and corporate financing. This is why analysts worry the silver derivatives issue is not just a metals story. It could potentially become a broader financial stability story. Another warning sign is rising delivery premiums in some physical silver markets. Premium increases often signal that real supply is tighter than official futures prices suggest. When physical and paper prices begin separating, trust in the pricing mechanism starts weakening. And once trust weakens, markets can reprice extremely quickly. Large institutional investors understand this dynamic very well. That is why some funds have quietly shifted portions of their holdings into allocated physical storage. Allocated storage means the metal is specifically reserved and cannot be rehypothecated. In simple terms, it means the silver is truly yours and not part of the derivative lending chain. This behavior mirrors patterns seen before previous commodity squeezes. Smart money often moves toward direct ownership before volatility spikes. None of this guarantees a crisis tomorrow morning. But financial history shows that systemic risks build slowly, then release suddenly. The 2008 collapse did not start the day banks failed. It started years earlier when leverage quietly expanded beyond sustainable levels. Today, many market observers believe the silver derivative structure may already be beyond that sustainable threshold. And the longer the imbalance continues, the more violent the eventual correction could be. For everyday viewers, this does not mean panic buying or emotional decisions. It means staying informed and understanding how interconnected modern financial systems really are. Because the biggest losses in history rarely came from events people saw coming clearly. They came from risks people assumed were impossible. If this breakdown helped you see the silver market in a new way, tell us what you think could happen next in the comments. Your perspective actually helps shape future investigations here at Bullion Alert HQ. And if you know someone following the economy, precious metals, or market risks, share this video with them so they can understand what may be developing beneath the surface. Financial awareness spreads best when informed viewers pass information forward. Stay alert, stay calm, and keep watching the signals instead of the headlines. Because in modern markets, the quiet structural shifts are always the ones that matter most.